because it is trying to talk to that one. Now it is coming. No? Now can you check on the tube? Now it will come. Hmm? Some delays there because there is a feature in there. All right, so let's start now. Basics of options. For this session is dedicated to our best data analytics guy on the planet right now, Mr. Jaydev. I don't know the next moment. I hope he keeps working very hard. So we are studying a topic which is known as, what is the topic known as? Derivatives. This is known as derivatives. Now, Jaydev, why is this known as derivatives? Because because it acts as a contact or contact. Okay.
It doesn't have a fixed price. It can be traded multiple platforms. The price is not constant.
Okay.
So
these prices that you're seeing, see here, the prices that you're seeing here, in a certain case there is no price because no one has traded. If there is a trade, there will be price. If there is no trade, there will be no price. Because the buy and sell. So these derivatives, this price is derived from something. And what it has been derived from? It has been derived from something which is on the top, which is, let me just show it to you. If I can show this to you, the prices have been derived. And I think, let me remove this, what I call is, can I just refresh this? Yes, I don't want this, so I can teach. So the prices Jaydev have been derived. This price that you see, this LTP column, this is essentially the price, and this is essentially the price of an instrument which is known as call, price of an instrument which is known as put. The prices have been derived from this one. This instrument is known as, what is the name of the instrument? This instrument is known as, and the price, the last traded price of Nifty is this one, and this price has been derived. The put prices have been derived here and the call price. Understood? Is this point clear? Let's see if I can try and pull out an older expiry, if that is possible. Historical prices not. ठीक है, चलिए. So now let us understand. Okay. Now let us understand what this is all about. Okay. So derivative one is, there are two types of derivatives. There are multiple types of derivatives. I mean, as you research more, you realize that there are numerous types of derivatives and there is no end to it. One is, the simplest form is futures, the second form is options, there are swaps, there will be forwards, and there will be structured products. Structured products. So you go on mixing, you can have with the bonds, you can mix options, okay? With equities, you can mix options. You can mix options of various options plus options, and there is no dearth of instruments. Those are the type of asset classes. So there could be a bond plus an option. There could be an equity plus an option. These are shares. You can have option and option, or you can have commodity. So various asset classes, you can just go on mixing things, and these will be known as structured products. But right now what we are learning about is not a forward, not a structured product, not a swap. We just focus on options. Now what are options? When they teach you in the book, it is right to buy and right to sell, and people get confused. Every book talks about right to buy, but that is how the options have evolved. That is not what the option means right now in most of the cases. In certain cases, yes, the definition of right to buy and right to sell exists, but in most of the cases, especially in the financial derivatives, it has become something else. Okay? So what is a call option? If you are bullish on an A instrument, and in this case Nifty, you would simply buy a call option. Okay? And you are understanding from data analysis point of view. Correct? So you are not understanding this from speculation, you are not understanding from trading point of view. Your focus is very clear. This is from data analysis. The data that you download, the structure that you download, the data structure that you download, how to read that. Because if you're not able to read this, this is useless. And this is exactly what we do when we train the product teams of the various financial intermediaries. We are training them on the data structure. So this is the data structure class. So when you buy a call option, you are expecting the market to move up. This is bullish. Bullish means, you know, a bull like something like this. You're expecting the markets to move up. Up. This the tail is pointing towards it. Okay. So you are expecting the markets to move up. When you are buying a put option, when you are buying what? So when you are buying this instrument for which the price quoted is this one, then you are expecting the markets to move. When you are buying this instrument, you are expecting the markets to, at this price, you are expecting the markets to go bearish or down. So bearish is represented by a bear, and frankly speaking, I never learned in my drawing class how to draw a bear. I can only draw a dog or a dog looking thing. So you are expecting the markets. But the next question for you to understand is when. I spoke about stipulated time and I spoke about stipulated distance. So by 2nd of June, you are expecting the markets to go up or you are expecting the markets to go down. Clear? By a certain amount of time. What is the time we have mentioned? 2nd of June. And all these stipulated times are Tuesdays. So you're expecting the markets to go down by 2nd June if you buy this product or a contract. When you buy, it becomes a contract. Okay? When you buy or sell, you are governed by the and hence this is a contract. Because there are roles and responsibilities that every party has to do. Who are the parties to this contract? Huh? Who are the parties to the contract? So buyer has a role and hence a responsibility. Seller has a role and hence a responsibility. Understood? This is where right to buy and right to sell comes. So when you're thinking from a contract act, then you're thinking from a right to buy and right. But can you think from a contract act all the times? No. When you're on the trading desk, it is purely from a money making point of view. Hence the right to buy and right to sell does not apply. But when you come to the deliverable part of it, who will do what, then you are bothered about right to buy and right to sell. Is it clear? Yes or no? There were no computers, there was no apps, there was no internet. So people were bothered about their roles and responsibilities while getting into this product, which is nothing but a contract, and hence they were talking only in terms of buying. But today, if you just talk about buy and sell, then you're on a trading desk, I don't know what you're doing, because it will come, this right to buy and sell, someone will think on this on the date when the date is over. If you are a pure trader, you just enter the contract and go away. Enter and wait. It's like a buyer and seller. You are speculating. So we'll come to that. So now have you understand why we not talk about right to buy and sell? Because I'm not thinking from the contractor perspective. I'm not thinking from enforcing perspective. I'm thinking purely from a trader perspective. The trader has only one mindset: buy and sell, make profits, not get into legal part of it. Is he there to fight? Is he there to enforce it? No, his just idea is buy and sell, buy and sell. Like you're buying a house and selling it, buying and selling, not retaining it. Right? Now, so this is the stipulated time. So if I choose a product which is ending 2nd of June 2026, I only have time to make money via a bullish opinion, that is called via a bearish opinion. I only have time until 2nd of June 2026. If I buy this contract instead, then I have time till 9th of June to make money either via a bullish position, which is a call option, or a bearish position, which is put option. If I buy via this contract, if I buy, then this will be called 16th of June. I time have. So then the next question arises is, what is the name of this contract that I'm buying? What am I buying? From a Securities Act perspective, the name of this contract is this. They don't teach in the books. Please remember this. No one is teaching a call and put from a securities contract perspective. Please remember this. So when you buy this contract, listen to it carefully. Okay, the name of this, let me show you the nomenclature. Let me show you how it would appear in your statements. And I need a writing instrument here. Maybe this side of the instrument will help. And here you go. Just hold it. Okay. So, all right. When you're buying this instrument, what is the contract that you're getting into? What you should first know, what are you stepping into? So the name of the contract will be 2nd June 21,100 Nifty, and this is which strike. So the name of the contract would be Nifty 50 21,100 call option, represented by CE. When you get into a put option, the name would be, the nomenclature would be Nifty 50, the strike that you have chosen, which is 21,000, and represented by a word or letters called P. Understood? Now, why this is E and why this is not A, we will discuss that later. So you can have a CA also, or you can have a PA also, but in India there is only CE and there is only P. There used to be both CE and CA, PE and PA, but we cannot handle that today. Okay. So why now? What is the idea of this option is that you're trying to make money, either buy or sell, by buying a call option or a put option, depending on the opinion, the view that you have got. Okay? Within this stipulated time. This stipulated time is, you have time for this contract. The contract is valid only till which time frame? So there is a stipulated. After that, the product would be dead. The word it would have, contract would have, and hence this date is known as. Now listen to this carefully. Because it is an exchange, the expiry dates are all same in terms of the day. It's a contract, it's a standardized contract. That's why all the expiry dates, when you click on this one, all the expiry dates are what? Are Tuesday. Why is that? Why is that? Because exchange gives you standardized contracts. That is why this is a Tuesday, this is a Tuesday, this is a Tuesday, this is a Tuesday.
Before it was Friday.
Before it was Thursday. And they're talking about switching to Fridays, then it is Tuesday. So the point is, why this is all Tuesday, or why these are all Tuesdays, is because exchange offers you standardized product. You can't choose Tuesday and then a Wednesday and then a Thursday and a Friday. That's not possible. It's all about standardization of the contract, so it becomes comparable, so it is easy to trade. Understood? So we spoke about the stipulated time. Now let us talk about the stipulated distance. These are the two things that you'll carry home today, and tonight you'll work on this one. From a data structure perspective, the idea is not trading here. Please understand, this is not a buy or sell recommendation of any sense, and it should not be taken in that sense. It will be useless if in a data analytics class, if anything is construed as a buy or sell recommendation. Now it's all about the distance, the stipulated distance. Say for example, you buy a contract of 24,100 call option. This is what you buy. What is the meaning of this one? What is the meaning of this one? Just close the window at the back. What is the meaning of this one? If you buy a call option, the whole intent is that if Nifty, which is right now here at this level, how do I know it is at this level? Look at where the color changes. This is where the Nifty is, and you would also know from this point. The closest number is right. If it travels from here to here, I'm talking about the stipulated difference, the distance. If it travels from here to here and crosses this one, this distance, if it crosses, then you make the real. And if it keeps traveling to higher numbers, this scale is slightly inverted. So the lower numbers are higher numbers are lower. The scale is the way it is placed. If it keeps traveling to the higher numbers, then you would make tremendous, you can possibly make unlimited amount of money. But the time you have available is not infinity. The time that is available to you is only 5 working days, which is until 2nd June. And the distance that it needs to cover is, it needs to travel, Nifty needs to travel from 23,900 to 24,100 for you to make maximum amount of money. The question is, do you make money between 23,900 and 24,100 if Nifty, say Nifty was here at 23,900 and Nifty starts moving upwards? Do you make money? The answer is yes, you make money. But you don't make tremendous amount. You make tremendous amount of money only when Nifty travels north. Okay? From a data science perspective, think the opposite side of it. Okay? When will you make money, or when one will make money? However, we are analyzing something else only. We are not analyzing price, and we are analyzing gamma, theta, the clustering part of it. Our study is very different. We are not bothered about the prices and all. That's not our. When you are looking at this one, you make tremendous amount of money. Possibly, there are unlimited number of people losing tremendous amount, 90% plus. But if the view comes, so by 2nd of June, say you have bought this number, because this is a bearish instrument. Put is a bearish instrument. This side to this side, everything is bearish. All the data is bearish. So say I choose this put option of 23,700. If market falls to 23,700, I make little bit of money. But if it crosses the stipulated distance, then I am rewarded more. And the reward could be infinite, but that never happens. Unfortunately, a lot of people lose a lot of money, according to SEBI, more than 90%. That's a different thing why we lose money. That's because it's not a trading class. But theoretically, what you're trying to understand is, if you have chosen this hurdle rate, or also known as strike rate, if you cover this distance from here to here, and if it falls below this, then your money making speed accelerates. Here the money grows. If it falls from 23,900 to 850, you make some money at a slower pace. If it travels from here to here, you make money, a smaller money in absolute terms. When it goes from here to here, you make money at an accelerated pace when it falls. So, but what is the time limit on you? Can you make this contract? Is it valid till 2nd of June? is it available till infinity? The answer is no. This is available, this facility to you, the possibility of money making is available only till 2nd of June. So now let me introduce something. Let me remove this one. It's not this one. Now let me introduce something. The point is, what are we studying here? I just wanted to show you NSE's option chain, which you are referring every day just to collect data and do a lot of studies. So the point is, if this is the scale, okay, if say this is 24,000 and say this is every 50 marks here, okay, so this is 24,050, this is 24,100, this is 150, this is 200, you have 24, 24, 24, okay. This is how much? 950, 900, 850, 800. These are the stipulated distances. By this time, you also know that because this is an exchange, the distances are standard or standardized. Understood? And NSE has decided to choose only difference of 50 points. That is a standardized contract. It comes from, it's their decision and it's their, but that is how it is structured. It's a standardized product. So these are distances. If you have chosen a call option, if you have gotten into a call option, say this number, the real money will come when this crosses this hurdle, and this is known as, sorry, we have plotted it differently, the upper distance. Say you have chosen 24,000, you have chosen 24,001. So for this, bullish instrument, what would you need? Call option, and you would make real money only once it crosses this. Understood? If you have chosen a put option, you will choose lower numbers. So maybe you have chosen 850. The real money you will only make when Nifty drops below 23,850 points. Understood? So these are known as strike levels, also known as, these distances are known as strike levels or also known as hurdle rates, and commonly known as strikes. Is it clear? So this is on the call side, put side. Clear hai, Jadev? I hope it is clear. Hai? And then because you are getting under contract, you'll have to pay a price for that. And that is quoted by LTP on the left side here and the LTP here on the whichever contract you bought. So you'll have to buy this put option or you will have to buy this call option. Okay? Is that clear? Clear understanding? This is clear. Jadev, is this clear? Now, if you can buy a call option, the entire example that I've told you is built around buying a call option, correct? If you can buy a call option, then you can also sell it. If you can buy a put option, then you can also sell. So if you can buy a put option, you can also sell it. ठीक है? LTP आपने समझ लिया, buy समझ लिया, call समझ लिया. Now, in a very simple language, this is clear. In a very simple language, in a very simple and few sentences before we wrap up now. I know it's getting late for you. The LTP that you just noticed, आपने देखा ना, LTP notice किया ना आपने? I hope you. ठीक है? LTP you have just noticed. LTP you have just noticed. ये देख लीजिए last sentence for the day. The LTP that you just noticed, that price is changing. There is a noise in the price daily. Sometimes going up, sometimes going down, sometimes going down. That is, we are collecting minute by minute data, or 3 minutes by 3 minutes. Whether it is a call price or whether it is a put price, what you are noticing is noise in the price, variation in the price. So noise is also defined by variation in the prices, and that is also represented by, that is also known by a word called समझे आप? Now you know where I am leading to. So the change in the price is also known as volatility. Now volatility, if you are downloading yesterday's file, relates to a function. If you are downloading yesterday's file, it would be known as, correct? If you are looking at, if you are looking at downloading yesterday's option file, listen to it carefully. Slightly tweaked my definition. If you're downloading yesterday's option file, it will be known as HV. If you are downloading minute by minute change, है ना, or minute by minute change, listen to it carefully, of Nifty, the underlying, the asset class. Call and put is based on this one. If you're actually downloading this one, then this would be known as, RV. What would be this known as? This would be known as RV. Okay? But I have slightly tweaked it. I said of the underlying of the, because you are not noticing what is the price change in the option prices. You're noticing actually how much Nifty is moving, because all of this you are trying to understand or predict or speculate the movement of Nifty. Hence I said minute by minute change. If you're looking at, we are looking at the realized volatility. This is where there is a slight difference. Realized volatility. Okay? And the last sentence is, if you're downloading the historical price of this one, it is known as HV. If you are trying to predict the movement of option prices in coming times or in future until 2nd of June, then this would be known as implied volatility. So basically, if you're looking the data backwards, it is HV. If you're looking at the data forward ways, it is IV. And if you're downloading the Nifty, then it is known as realized volatility. So we have covered volatility. We spoke about prices. We spoke about upward movement of prices via call option, a view on it. You take a view. The contract is for taking a view. You want to make money by, or you want to analyze the data which is helping you make money because the prices move up when Nifty moves up. It's call option. When Nifty goes down, so the put prices increase. Now the last thing, HV, yes, HV is standard deviation, and Black-Scholes IV is Black-Scholes. Okay, so when Nifty goes up, call prices move up. Okay, put prices go down. When Nifty moves down, and most of you know this, but it is easy to know, and it is essential that you know this, because the next chapter I know that you are in sync, because we are all at the same page. Otherwise, it becomes difficult. If people come at different time frames, then the put prices will. And this variation, this is a variation. This is delta. Price is going up, down, up, down, up. This is known as volatility. Understood? So we'll stop here. Thank you, and God bless you all. We'll stop it here. Thank you.